Let's talk China. Our guest is bullish on the prospects of some of these Chinese technology giants. He says Chinese internet firms are set for the highest growth in 7 years. We're joined by Beeneet Kothari, CEO and Principal Portfolio Manager at Tekne Capital Management. And Beeneet, thanks very much indeed for joining us. This is interesting. Tekne, it's a $1.2 billion US hedge fund, and you were a protege of Stan Druckenmiller, the legendary investor, but you went out on your own quite a few years ago.
Yeah, that's right. We've been running Tekne now for over a decade, and we've got a global presence. I'm based in New York, but we've got team members across Brazil, Europe, Central Asia, India, China, Southeast Asia.
Give us your thesis on Chinese tech. I mean, that's a very broad subject, I know, but you see tremendous growth in AI models from China, and they're going to be open source. What's significant about that?
Well, I think the most important thing to remember is the DeepSeek moment in China is 3 months old, whereas ChatGPT in the US is going back to 2022, over 3 years old. And so we sort of know what's going to happen in China. What's going to happen in China is exactly what happened in the US over the last 3 years, which is a massive spending boom. And it's going to benefit a number of companies that are well positioned. And I think the rate of innovation will be substantially greater because they've already started to improve on some of the mistakes and differences that the US strategy has employed. So I think you're about to see a repeat. Except the big difference is you're starting at a much lower valuation in China and much less ownership of these stocks.
Because we want to hear about these three names you have. GDS Holdings, you like the look of this one. What attracts you here?
It's the largest, one of the largest data centers in China. And so the way I think about GDS is they are a landlord on AI. Every model that gets developed, whether it's open source or closed source, every chip that gets deployed, whether it's a Huawei chip or an NVIDIA chip, is going to need power. And the only place to get these powers is data centers. And the biggest and the best data center asset is GDS. And the amazing thing about GDS is they not only have large assets in China, but they've also got them in Southeast Asia in a business that they incubated from scratch called Day One. That business is now worth billions of dollars, and they are on the process of spinning that business out maybe as early as next year. So you've got a stock which is about to do a major split. You're going to have a really nice China asset. You're going to have a wonderful global asset that there's demand for. And this is all happening just as the AI boom is beginning, right? Remember, we're only 3 months in.
So they're a data center operator. So the massive increase in computing needed for AI could be a boom for them.
Yeah. I think this is what you're seeing in the US. This is what you're seeing in the Middle East with Trump over there on the deals he's announced. And this is what you're going to see across Asia.
DiDi Global, remind us what they do and tell us why you like them.
So DiDi is the Uber of China, focused on ride hailing. This was a company that tried to go public 3 years ago, was slapped with a number of fines, had to delist, trades on the pink sheets. And that whole time, the underlying business has been improving and continuing to grow. Profitability has gone from the red to positive. The company has already done $1 billion buyback on the pink sheets. It's in the process of completing a $2 billion buyback on the pink sheets. These are unheard of numbers. It's one of the largest companies to ever list on the pink sheets. Most companies end up on the pink sheets because they went out of business or they're bankrupt. This company went to the pink sheet simply because they needed to relist. And that's the big catalyst that'll get unlocked potentially as early as the back half of this year, if not certainly next year. And the stock trades at a single-digit multiple of its profits. And we think once the company gets listed, it's going to trade at a valuation substantially closer to when it went public. Now, it went public at $15 a share. The stock's today less than $5 a share, but the business is stronger. It's a bigger, more profitable, better business today than it was when it went public. The stock price is a third of what it was.
Just when I hear pink sheets, though, I think of Wolf of Wall Street, and I'm wary. You're a sophisticated player, but pink sheets, I mean, they are notorious, aren't they?
That's the opportunity. So that's the sort of red flag on the company that's going to get lifted as soon as the next 6 months. But you don't want to wait for that to happen. Once the company relists on a major stock exchange like Hong Kong or mainland China or the NASDAQ, at that point, the price will get repriced at a level more appropriate for institutional investors. So here's what I could tell you. Almost no major mutual fund in the world, which is where the vast majority of capital sits, can own pink sheet stocks for exactly the reasons you mentioned. So I think if you're an able investor and you're sophisticated and you can sort of, sift through the bad companies from the good businesses, you can take an advantage of this price opportunity.
We'd better jump. Beeneet, thank you very much indeed. I hope you come back soon, because I know you have a lot more to say about Chinese tech and the prospects for a boom. Beeneet Kothari has been our guest, CEO and Principal Portfolio Manager at Tekne Capital Management.